The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate?
It was initially the 12% return, but it quickly turned into the people.
Hi, and welcome back to another episode of the Multifamily Masterclass. I'm Bart Deal, and today I'm joined by two incredible guests, Jameson Manwaring and Heidi Butler. We got a great slate of topics today. The first topic we are going to go over is a recap of quarter one of 2025. And I'll just say this, guys, it's been a big and exciting quarter. Thank you to all of our investors who have invested in some of our deals. The next thing we're going to talk about is some articles. The first article is a TSMC article talking about their latest investment in Arizona. And then the second article is tariffs and how they may affect multifamily. But to dive right into the first topic, recap of Q1 2025. So in January, we added our third asset to the REIT portfolio via an UPREIT exchange, venture on Elden. Jameson, why is this such a win for the REIT and also for Elden investors?
Yeah, we actually had our biggest quarter in the history of the company for raising new capital. And it's interesting right now is a difficult time still in multifamily with high interest rates, rents that have been flat for a couple years. But as we talk about what ended up happening in the quarter, beginning with this first UPREIT transaction, we had our biggest quarter ever.
Yeah.
And we're being opportunistic on what's available out there right now instead of saying, well, the things aren't the way they were 2 years ago, we can't do anything. We started pivoting and looking for new opportunities and really excited about what happened in the quarter in general. And our project venture on Elden, we had went through the process of the 3-year hold period when we bought it at a really good entry price in Flagstaff. It's a smaller building, 17 units, but it's right in the middle of Flagstaff, and Flagstaff's a growing area. It's really hard to build in Flagstaff, landlocked, so we like buying key assets in Flagstaff, and the property cash flows really well. So after we did the renovations, rents went up about 100%. So rents are now about $2,000 a month for the units. When we bought it, it was like $900.
Wow.
So we made them a lot nicer though. Added ACs in the units, washer and dryer. So it's a great place to live right in the middle of Flagstaff. So that's why we're getting that type of rent. And instead of selling the building, after you do all this work and you reposition an asset that wasn't doing well and now it's generating really good cash flow. Now that we have the REIT, we wanted to keep it in the REIT long term. We wanted to benefit from the further upside. I like to say, there's still some juice there to squeeze out of that. And if you sell it, you leave that on the table. But by keeping it in the REIT, both the company and all the investors in the REIT now benefit from the further upside, and that made a lot of sense for Elden. So really excited. That's our third asset in the REIT, and I think there's going to be several more coming this year that we're working on, and should be a good time for multifamily for the next couple of years.
And Bart, I know, I watched just kind of from our side of the departments. What was it like? What were investors' reactions to doing an UPREIT for Elden specifically?
Yeah, it comes down to education because it's new. It's similar to 1031. It's a 721 exchange. But once our investors get it and they understand the benefits of this, wait, I get to continue to earn from this asset and other assets and future assets, all while realizing my full investment and it's tax deferred. It seems like a win to me. So our investors have been happy with it. And then for the investors that wanted liquidity, we were able to redeem them out. They're within the redemption window for the next quarter.
Yeah. One of the benefits, I think, of our REIT specifically is investors, and just the way we structure our company, investors can start in on a property deal that they love. And with the REIT, when we find assets we love and want to hold, and investors love and want to hold, this allows us to do that. And it's so fun for investors to carry on this property and go to the next level with it and kind of graduate, if you would say, from a renovation project into a cash flowing asset, but continue to see the benefits of it going forward.
Yeah, and there's definitely been a handful of investors that were part of Elden that are already asking, hey, what's the next one you guys are doing?
Yeah.
Because they're invested in all of our projects. So they're excited about the possibility for more UPREITs in the future.
And you have to remember with real estate and pretty much all good investments, but real estate in particular, you do well in the long term. So we're in a down cycle right now with real estate. If you're selling today, if you're forced to sell today, it's not a good time to sell an apartment building today. You can do okay, but it's not the optimal time. And that's the nature of a cyclical industry. So what you want to do is sell when it's the good time to sell and hold when it's not a great time to sell. So this allows our investors and our folks who are involved to have a long-term mindset. Typically, the REIT plans to hold each asset for 10 years, but I'll tell you, we'll be opportunistic. If the market comes back roaring and we're at the peak, we'll sell a bunch of assets and move on. So it helps, investors might want to invest in one project to get going, and then what we want to help them convert to is a long-term mindset with their investing.
And one thing I think we lightly touched on here is with the REIT, it is tax deferred. So you go into this UPREIT structure without having to pay gains on all the depreciation you've taken over time on the asset. And you talked about selling the property. When we go to sell it, we do plan to do a 1031 into another asset. So you'll just continue to defer that as long as you stay into the REIT. Not trying to get in the weeds there, but just understanding how that flows through. It's a huge tax benefit for investors.
And I think the thing that makes real estate interesting is, we're kind of drawn to the fact that we can drive by it and we can see it, and that's one of the initial reasons why we're drawn to real estate. But what really, the reason why so many wealthy people own real estate and why people get wealthy from real estate is because of all the tax advantages, because of tax shield through, Heidi just mentioned, depreciation. We're not getting into all the weeds today, but we implement all of these because we've been doing this for a while. We know what we're doing, and that benefits all of our investors. We basically do that work for them within the REIT. That's the draw of real estate. It's not just, that building looks good and those units look good. There's all this stuff under the hood that add to it.
Yeah, a lot of good things to say about the REIT. Great January for us and our investors. But I want to move on to February and talk about our first acquisition that we made in the Opportunistic Fund. Venture on Coulter, which is a 123-unit multifamily building purchased at a 30% plus discount located adjacent to GCU. So I want to just talk about how we found this deal and why do we love it.
Yeah, we have been looking at this deal for 7 or 8 months. We knew the operator had invested a bunch of capital into it, about $2 million into it, only a few years prior. So the property was looking good, but he'd overextended himself. He had too much debt and couldn't afford the higher interest debt payments. So when he was initially looking at it, maybe his debt payments, he was thinking were going to be 4 or 5%. Then all of a sudden they were 10 or 11%, and the debt didn't make sense anymore. And it got to a point where he tried to sell it before handing it back to the bank. Then the bank came in and took it over, and we bought it directly for the bank for his debt amount, which is $105,000 per unit. And anyone who has been around construction and building and the apartment resale space, if you talk about buying a property in the middle of Phoenix, and this is in a good neighborhood. This isn't in a really rough part of town. It's an up-and-coming part of town next to GCU. But if you can buy a building for $105,000 a unit, 2-3 years ago, their jaws would have dropped. There's no way. So it was really opportunistic. We had to work with the lender really closely and pretty privately because they didn't want to be the way lenders work is they want things to stay pretty confidential. So we had a unique relationship with them. That's how we were able to acquire the building after it was taken off the market and taken back by the lender. And the big thing is we needed to get the occupancy up. So it was about 75% occupied, low 70s. Not to reveal too much, but occupancy has already shot up.
Wow.
We're almost 80%, just at 80% occupancy in the first 5 weeks. We have a great property manager running it, and our sole focus is to get these remaining units leased up. So we're on a good trajectory. And the last thing to think about with real estate investment is replacement cost. What would it cost to build this brand new? depending on who you talk to, for one bedrooms, half of these are one bedrooms, half are studios. It's about $200,000 to $250,000 a unit to build that
Wow.
from the ground up today, and we bought it for 105,000 units. So when we talk about great acquisitions in the future, I think we'll be looking at Coulter as one of those great acquisitions we made.
And if you think about our risk appetite into what we've been looking for in the market, obviously shifts over the last few years from projects where we do full renovations to distressed properties in the sense of management issues, things like that. In this case, obviously owner issues and management. Those are things that we can come in and fix. Those are things within our control that don't cost us a lot of money that we can come in and make improvements on that provide a great ROI to investors. And this is a great one where their costs were not well controlled. There wasn't any one manager that was running it, that was maintaining it because of the handoff over the last few months. That's something that we have in-house maintenance. We have an in-house property management company that handles everything and cares for it so well, brings down those costs, brings up occupancy, makes us a great asset overall.
Yeah, so great February. Thank you to the investors that are invested in Venture on Coulter, whether it's directly or via the Opportunistic Fund. We believe it's going to be a great asset in the future. I do want to dive into March. So in March, we made our second big acquisition in the Opportunistic Fund, Venture on 52nd, and this is a beautiful 71-unit building located in Arcadia, and we purchased it at an over 35% plus discount. So same thing, I want to recap this. How do we find this deal? What do we love about it?
Well, in February with Venture on Coulter, we had our largest ever fundraise of $4.5 million.
Yeah.
That was our biggest in our 7-year history. And then March came around, and we had our next biggest, another new record, raising $5.5 million on Venture on 52nd. So that's why we had our biggest quarter ever. We've done our 2 largest deals. And this one is similar, where the owner had purchased it at the top of the market in 2022 for $18.25 million. They had higher debt payments as interest rates went up. Property started not cash flowing well. This particular operator had third-party managers running it. Yeah. So when that happens, it's hard to really roll up your sleeves and go try to fix problems of the property because you're relying on a third party. Then the lender that they were working with would not extend their loan. They basically required a refinance, and they weren't able to refinance it because they had too much debt. It would have required a lot of capital for a cash-in refinance, so they weren't able to refinance it. So the lender took it back in foreclosure. This was the first time that we actually bought a property in foreclosure. We had a partner who won the bid in the foreclosure auction, and then had 5 days to decide if they wanted to move forward and write a check for the rest of the near $11 million to buy it in foreclosure. And again, the owner had bought it for $18.25 million 2 years prior. So we're buying it in foreclosure at $11 million. And in that 5-day window, our partner, we had several meetings, and we said we would love to purchase this in this foreclosure. So we worked out the agreement with them. They temporarily held it for us. They wrote that large check at the close, and then we had about 60 days to get our funds together, and we ended up putting all our funds together to buy them out and execute that purchase. So it went very well. It was the first time we've done that. I think we're going to do more with that partner. They loved the process. They're a really nimble lender, and we now have a proven track record with them. And these are hard deals to find. So the other thing that happened in the quarter is the 2 larger apartment deals. Maybe there were some 2-unit or 4-unit deals that went into foreclosure. The 2 large apartment deals in the valley we bought that went into foreclosure. Awesome. So we have direct access to these deals like very few people do, and we have the support from our investors. That when we go buy them, our investors get it. They know that we're in the downside of the cycle. Let's buy low. Remember, buy low, sell high. So buy as much as you can in the downside of the cycle. Our operations team's going to come in, do a great job, and then you'll do well as an investor if you can do that.
So since we've taken it over, I know it's been only a month, but how is it performing now? Are there any key things you guys want to talk about?
Yeah, occupancy, mostly the biggest thing was their rents that they were offering at the time
Yeah.
were what I would consider below market rents. Not substantially low, like we were talking about Elden before, but below. There was no
Yeah.
incentive to try to push the market rents up. We went in and immediately raised rents, and we were able to achieve it almost right away. Minor touch-ups on units, the ability to walk it, own it, take ownership of the
Yeah.
property as a whole. Rents have come up, tenants are super satisfied, and we see a lot of what's something really unique to our business and our property management is we see a lot of tenants transfer from one property to another.
Yeah.
As their life changes, they move in. So we had a lot of tenants who 52nd was closer to their work and moved from different properties there, and vice versa. So it's a really unique community that we have, but bringing up rents is something that I've noticed right away.
Yeah, and it was like Heidi said, it wasn't drastically below, but probably 15 to 20% below the market.
Mm-hmm.
And that was because the manager, third party manager, again, they just were focusing on occupancy, not cash flow.
Yeah.
When you own it, you care about cash flow. So when we came in, we're like, wait a second, we like the occupancy, we like the fact that there's no vacancies here, but they need to be paying the market rent. So we it's not like we're trying to gouge people. We're just taking it to what the market is, what our neighbors are next door, what the equivalent is, and that hasn't been difficult to bring those rents up about 15 to 20%. And that's going to take about a year because remember, everyone's on a year lease. So as these come up and they renew, we take them up. And so to Heidi's point, what we've already found is people are happily renewing at the higher rent. And that's why we have confidence we'll be able to take the rents up across the board over the first year.
Jumping to kind of the other side of these properties, the investment side, with 2 huge months raising on both of these properties, with the Opportunistic Fund, do you feel like that helped investors feel better about the deals? How did that affect fundraising overall?
I can jump into this because the investor sentiment in 2024 is they knew there was going to be distress. But towards the end of 2024, they were like, when are you guys going to make the first acquisition? And then we started the year off with a bang. We have 2 really good assets purchased at over 30% discounts. And we are so grateful to our investors that invested in the fund last year because that helped us be able to close on these deals and close on them quick. Do you have something to add to that?
Yeah, because I wanted to buy something earlier too for the fund. We were trying, but some of these things take some time,
Yeah.
and banks are not quick when they're going into foreclosure, and you kind of want to see it play out. So 2024, we had, in fact, Coulter was a deal we looked at, and we let it play out. We kind of stepped back, and
Yep.
what's the old saying? Let something go, and if it comes back to you, then it's probably the right thing. And so now, as we look into 2025, a lot of this stuff is starting to come back. A lot of what happened in 2024 was what we call extend and pretend. What that means is the lenders extend your loan, but they don't make you write it down or market to market. They just keep it the same and kind of pretend everything's fine. That stopped. That's all coming to an end in 2025. Lenders are now saying, wait a second, you owe a lot more than what this is worth. Now you need to go figure this out, recapitalize it. So we're going to see a lot more come. I'm very happy now we didn't push some of these other deals in 2024 and we kind of waited on it. And then I also think from a purchase standpoint, the fact that we have dry powder and that we can close in a short period of time, like we did on Venture on 52nd, we were able to close within 60 days. That means we got a loan in place. We had all our funds in place. That was a very quick turnaround, and that's a big advantage when we're talking to a bank or when we're talking to a distressed seller where we can say, look, there's 2 other people who you're talking to, but we've closed 2 of these. We've closed them quickly, and we have the dry powder to close quickly, and we'll get a better price because of that.
So this is one of the first 2 deals that we've done where we've done kind of a hybrid model where the Opportunistic Fund is investing as well as our 12% preferred Arizona interstate investors.
Yeah.
How is the mix going together? Are we seeing a lot of Arizona interstate investors excited about these deals because there's more different types in there?
Yeah. Yeah. So when we launched the Opportunistic Fund, a lot of the investors are more keen, not a lot, but plenty of our investors are more keen to investing directly into the asset. And that's because they can do their due diligence. They can go drive by the asset. When you're investing in the fund structure, although the returns are a little bit higher, you're investing in a blind pool of assets. You don't know what we're going to purchase, but there's more diversification in the fund structure. So the fact that we're able to give both options to the investor that wants more upside, they can invest in the opportunistic fund and get 16 to 20% returns, or the investor that likes a 12% preferred return, they can do their due diligence on the asset, go drive by it, and invest and hit their 12%. It's been nice to have both.
Yeah.
Yeah, and just like when you go to buy a pair of shoes, everybody has a different color, they have a different taste. So to be able to offer a few different ways to invest in our projects, it gives us the opportunity to listen more to what are the goals of the investor, what's their risk tolerance, what's important to them. Do they want distributions now? Do they just want growth? Some of that has to do with how old they are, how close they are to retirement. We're able to listen and then say, well, this is something you should think about. So I think it's been fun to have both of those options.
And then just one more question about it, because I know we're going to have investors who are asking this. If you're investing with a retirement account, is there one preferred over the other as far as investing directly in the fund or investing in the projects?
Again, it comes down to investment palette. If you're investing from a self-directed Roth account, those gains, you already paid the tax on it. So it's nice if you're going to invest in a vehicle that has more upside, like the opportunistic fund. But you're still going to have gains at the 12% preferred level too. So it really comes down to the investor's investment palette. Great. Well, with that, I want to dive into some of the articles that have came out recently. The first one is an article by the Phoenix Biz Journal, and it's titled TSMC to invest $100 billion in new Arizona fabs. So in the article, it says TSMC will invest as much as $100 billion to build 3 more computer chip factories, 2 advanced packaging centers, and a research and development center. This investment is expected to support 40,000 construction jobs over the next 4 years and create tens of thousands of high-paying, permanent, high-tech jobs in advanced chip manufacturing and R&D here in Arizona. So this expansion is also expected to generate more than $200 billion in indirect economic output in Arizona and within the U.S. within the next decade. I mean, we're a multifamily company, so what do you guys think this investment that TSMC is doing is going to have? What kind of effect is it going to have on the market?
Last year, John and I went to dinner with a group of investors, and they had brought along a few friends who were construction managers at the TSMC plant. And it was really interesting to talk to them, really bright young folks who had moved from out of state to help build the plant. And at the time, the TSMC commitment, I believe, was $40 million. Then they ended up increasing it to $60 million later. And now this is another $100 million on top of that. So we're talking like a $160 million investment.
That's crazy.
And at the dinner, I wanted to understand more about what was happening out there at TSMC, what is the scope of the work, and the big takeaway that I got was what we're building now is phase 1 of about 10. And what they do is as they build these plants, once one is done and is operable, they'll move to the second one and start building that, and it takes like 10 years to build one. So now they'll take the group over to the next one and build that and build the next. And basically, they just take it from one group to the next. And TSMC has such a large footprint of land that the folks we were at dinner with said, we're going to be building for about 50 years at this location without stopping. And then once we're done building in 50 years, we got to go back to the first plant and start remodeling that one. So this standpoint is from the people who are actually building the construction of the fabs, plants, and then the inside infrastructure. On top of that are all the people that are actually going to work there when they're done. So, and I know there's some people working there now, but I think it's small. What's going to happen is once the plant's actually fully completed and functioning, now we're going to see a workforce, highly educated, highly paid workforce that's going to start working there, and that's just going to grow for a long period of time. So anybody who has looked at this knows how much of a driver this is going to be for the future economic growth of the valley.
Yeah.
Not only is it the folks who are working at TSMC, but it's all the suppliers. There's a city now adjacent that's now a city within a city. 7,000 people are going to live there, and it's all everything that they need, and that's all because of TSMC. All of this growth because of this primary driver, and then that changes the landscape overall of the city from a largely construction and citrus and snowbirds who come here to live
Yeah.
to more of a tech education-driven workforce. ASU has shifted a lot of their degrees to now they're one of the largest producers of engineers to feed into this changing economy because of this.
Oh.
So it's when President Trump and the CEO of TSMC, he came here a few days into the new administration, and they came out with this new $100 million on top of the $60 billion. Sorry,
Yeah.
Another $100 billion on top of the $60 billion. It was like, here we go. This is real happening.
Well, I want to jump into our last article to talk about, and it's an article from BizNow titled U.S. Multifamily Firms May Be Winners of the Trade War. It's a long article, so I just want to summarize it and give some key takeaways, and then we can give our feedback. But the summary is, the article discusses how the latest round of U.S. tariffs, primarily targeting construction and automotive materials, could benefit existing multifamily property owners. So a 25% tariff on construction and automotive materials is set to take effect, potentially raising development costs by 3 to 5%. These increased costs, coupled with already high interest rates, could slow new apartment construction even further than what we're already seeing. So what does this mean for multifamily and operators who already own buildings?
Yeah, if you own fixed assets, anything today, the cost to replace that is going to be going up.
Yeah.
And that drives the current value. And that's kind of the simple way to put it. But the costs to build have already gone up. We have higher interest costs, and that disincentivizes developers from going and building more. And it's kind of weird to think about it, but if you own real estate, it doesn't really help you when a developer comes and builds more real estate, because that gives more supply into the ecosystem. And so when stuff like this happens and there's less incentive to go build because your costs are more, it makes the value of the existing assets even higher.
How does this affect overall? I mean, we're talking about multifamily specifically, but we're also talking about homes being built, all the different markets, people that were renters considering on buying new builds, now staying inside the renting market. How does this ripple effect into that group?
Yeah, it's the same impact, because to build a home's going to cost more. We already know that it's way cheaper right now to rent than to buy. Mm-hmm. So it makes no sense to buy today. And that's going to continue to be true as the cost to build new homes continues to go up. So I think that the thing that I'm thinking about as an investor myself, and then and our investors, is we want to buy today, not build. Right. So the interesting thing is, if we can go buy great assets that are distressed because the operator got some bad debt or they couldn't, go buy that today. And we've looked at building ground up in the last 12 months. It doesn't make sense. And our friends in the industry are saying the same thing. It doesn't make sense. So today is the time to buy, not to build.
Yeah, I think it's affecting everyone everywhere. And if you're buying a home, you're not buying at all. I have a few friends that are in the renting market, and they're looking at, fixer-uppers, regular homes, and new builds. Every single case, they have to spend money on new ACs, and everything is going up in price. They don't want that headache. They would rather rent, put it on the managers to figure all that stuff out, and avoid all those costs together and stay in the renter pool.
And rents have been flat for going on 2.5 years now. But landlords like us, our costs have gone up. Insurance costs almost 10% a year. Maintenance costs have gone up, and we haven't taken rents up. So we've eaten the brunt of that. But rents are due to go up. They have to go up. They've been arbitrarily low because we've seen all of this new construction get completed and go add to the supply. We've talked about this a lot on this podcast, but we're starting to see that turn around now because there's not going to be new supply. So if you are a renter, and you can, Heidi, your friends in the renter pool and others, your rents are going to start going up. I don't think they'll go up like they did during COVID, where they went up 20% a year for a couple of years. It's going to be more like a 5 to 10%, but you're going to see rent increases solidly for the next 4 or 5 years.
You're also going to see incentives to go to new places go away.
Absolutely.
So you're going to look at it. You're going to look at your renewal. You're going to look at what's in the market. And before you could get 30 days, 2 months off, now you're going to see very few concessions that they're going to offer.
Yeah, those all burn off.
In our last podcast, we actually talked about how absorption outpaced supply.
Yeah.
So with all this new demand moving to Arizona, all these new units coming onto the market, absorption of these units outpace the supply coming on, and then there's a drop off.
Yeah.
So where are these people going to go? And rents are going to go up from here.
For sure.
Thank you for listening to our podcast, The Multifamily Masterclass. Please subscribe to get all of our new episodes.